Technical analysis for Forex beginners. Key indicators and patterns. Technical analysis is a popular method used by Forex traders to analyze historical price data and make trading decisions based on patterns, trends, and indicators. It involves studying charts, identifying patterns, and using technical indicators to forecast future price movements. Here are some key indicators and patterns used in technical analysis for Forex beginners. Support and resistance levels. Support and resistance levels are areas on a price chart where the price tends to find support as it declines or encounters resistance as it rises. Support levels are considered as the floor below which the price is unlikely to fall, while resistance levels act as a ceiling above which the price is unlikely to rise. Beginners can identify support and resistance levels by analyzing previous price movements and looking for areas where the price has repeatedly reversed or stalled. These levels can serve as potential entry or exit points for trades and can help traders determine their risk levels. Trend lines. Trend lines are diagonal lines drawn on a price chart to represent the direction and strength of a trend. An uptrend is formed by connecting the higher lows, while a downtrend is formed by connecting the lower highs. Trend lines help traders visualize the overall market direction and identify potential entry points in line with the trend. Beginners should draw trend lines by connecting at least two significant swing lows in an uptrend or two significant swing highs in a downtrend. When the price approaches a trend line, it can act as a support or resistance level, and traders can look for trading opportunities based on the trend line interactions. Moving averages. Moving averages (MA) are widely used indicators that smooth out price fluctuations and help identify the direction of a trend. They calculate the average price over a specified period and plot it on the price chart. Commonly used moving averages include the simple moving average (SMA) and the exponential moving average (EMA). Beginners can use moving averages to identify trend reversals, confirm the direction of the trend, and generate trading signals. For example, when the price crosses above a moving average, it can signal a potential buying opportunity, and when the price crosses below a moving average, it can indicate a potential selling opportunity. Oscillators. Oscillators are indicators that help traders identify overbought and oversold conditions in the market. They provide signals when a currency pair may be due for a reversal or a correction. Some popular oscillators include the Relative Strength Index, RSI, Stochastic Oscillator, and Moving Average Convergence Divergence, MACD. Beginners can use oscillators to identify potential entry or exit points based on overbought or oversold conditions. For example, if an oscillator reaches or exceeds a certain threshold, for example 70 for RSI, it suggests that the currency pair may be overbought and a downward reversal could be imminent. Candlestick patterns. Candlestick patterns are graphical representations of price movements that provide valuable information about market sentiment and potential trend reversals. Candlestick patterns consist of individual candles or a combination of multiple candles and are formed based on the opening, closing, high and low prices within a given period. Beginners should familiarize themselves with common candlestick patterns such as doji, hammer, engulfing, and shooting star. These patterns can indicate market indecision, trend continuation, or trend reversal, providing potential trading opportunities. Chart patterns. Chart patterns are formations that appear on price charts and indicate potential trend reversals or continuations. Some common chart patterns include head and shoulders, double tops, double bottoms, triangles, and rectangles. These patterns are formed based on the relationship between support and resistance levels and can help traders anticipate future price movements. Beginners can learn to identify chart patterns by studying historical price charts and understanding the characteristics of each pattern. When a pattern is identified, traders can use it to generate potential entry or exit signals. Fibonacci Retracement. Fibonacci Retracement is a technical analysis tool based on the Fibonacci sequence, a mathematical sequence in which each number is the sum of the two preceding ones. In Forex trading, Fibonacci retracement levels are horizontal lines that indicate potential support or resistance levels based on the Fibonacci ratios. For example, 38.2%, 50%, and 61.8%. Beginners can use Fibonacci retracement levels to identify potential price reversal zones or areas where the price is likely to continue in the direction of the trend. By drawing Fibonacci retracement lines from swing highs to swing lows in an uptrend or from swing lows to swing highs in a downtrend, traders can identify these levels. Conclusion. Technical analysis is a powerful tool for Forex beginners to analyze price charts, identify patterns, and generate trading signals. By understanding key indicators and patterns, such as support and resistance levels, trend lines, moving averages, oscillators, candlestick patterns, chart patterns, and Fibonacci retracement, beginners can make more informed trading decisions. It's important to remember that technical analysis should be used in conjunction with other forms of analysis and risk management techniques. Continuous learning, practice, and experience are key to mastering technical analysis in Forex trading.